Hi, I'm Mike Gitlin. Welcome to another episode of our Capital Ideas podcast, where we get to know the people behind the portfolios. Today, we have Greg Miliotes with us. He's an equity portfolio manager based in San Francisco, been at Capital Group for 19 years. Greg's also a member of our management committee. Today's episode is a special one, our 50th recording, and it feels fitting to mark it with someone who embodies long-term thinking, humility, and continuous learning here at Capital Group. Greg, welcome to the podcast. So glad you are our 50th guest.
Thank you.
All right, so we're going to start off in Florida.
Okay.
And you worked at your parents' restaurant.
Yeah.
What did it teach you?
Yeah, looking back, there are two big things. One of them is we had to be really nimble, and there were so many challenges that came in that business. So we had a small German deli in a mall, and we started in the mid-1970s. The 1980s brought on food courts, and we had a huge amount of volume that went the wrong way. And then the 1990s, you had Bennigan's and TGI Fridays coming in and putting box restaurants in all these malls. So we had to be very agile when we saw these revenue headwinds of finding new ways of creating revenue, because there were real challenges to the business. And then the second piece is really around employees. Employees are super important for a small business. Do they feel comfortable? Do they come in? Do you hire well? Because if they don't come in, if they don't show, you're doing those jobs yourself. The managers and the owners have to step in and do it themselves. So employees and I think agility were a big piece of it.
Those map to Capital Group in some ways?
Yeah, of course.
There's talk a little bit about some of those lessons and how you maybe even invest today.
Yeah. I think they're very similar lessons, whether you're a very small restaurant in Clearwater, Florida, or you're a $100 billion market cap company in the S&P 500. That agility is one of the things we look for in management teams. They'll see challenges coming. Can they turn those into opportunities? That's super important because the challenges will come. The second piece on the employees, we meet with a lot of CEOs and CFOs. They're very important when you think about leadership, when you think about direction. However, the people that run the business often work before them and underneath them. Getting to know the rest of the team, how do they run the business, succession, culture, that's incredibly important as well.
How they work together.
Yeah, the incentive structures and the culture really matter. So yeah, Clearwater, Florida, $100 billion market cap, both super important.
So let's go from the restaurant to the hospital.
Yeah.
You ended up spending some summers working at the hospital, and you even were published on some melanoma and breast cancer research. So that's real. I mean, that's incredible work. How'd you go from medicine to what you're doing today? How'd you get from medicine to the markets?
Yeah, I started really having a interest in medicine long term. And my dad came to me really early on and said, look, if this is something you want as a career opportunity, you really should work there. You should get a sense of what it is before you do it. And I realized the concept of medicine that I had didn't necessarily meet the reality of it. So I started looking for other roles that could leverage that interest in healthcare, but maybe expand to new skill sets. And I was super fortunate to get a job as an equity research associate in biotech at an investment bank in California. And it started a 30-year career of investing around thinking of where does markets go. So it was really more about, I guess, a passion found rather than one that was planned.
But even in that first job, before you got here, you talked about stocks, you wrote about stocks, but you didn't put clients' money towards stocks. I think that's one of the reasons you joined here.
Yes, exactly. I think when I was in a formal role, I would be writing research, as you said, and I'd hand it to a portfolio manager. And ultimately, that portfolio manager, he or she would decide, do I buy it or do I not buy it? And increasingly, as I was writing recommendations and handing them off, I found that I was actually emulating who they were as an investor because I wanted them to buy the ideas. And in particular, the PM that I worked for was very growth-oriented. And I realized I'm not sure that's who I am. I know it's who he is. And I'm more and more trying to be who he is. So I got this opportunity when I came to Capital in the research portfolios, which allow us for the first time to take analysts 6 to 12 months here at Capital. Investing for the first time in the research portfolios was a huge advantage for me when I came here. And I think it did two things in particular. One is it allowed me to make my own mistakes for the first time. I could find myself as an investor. How do I think about risk? What resonates with me? Make my own mistakes and develop my own investment approach. The second thing was I had done healthcare for years. And Capital said, hey, we want you to try industrials. And I said, for the first time, I have to think about investing not only within a sector, but between the sectors. How does healthcare compare to industrials in terms of attractiveness? So having those research portfolios where you actually invest for the first time client capital, big development tool.
In that early phase, you must be learning a lot of lessons of, okay, it's become really real.
Yes.
And I have to do something now.
Right. Well, you do. What you ultimately do is you're trying to find yourself. And so in those early years, you're trying a lot. It's more experimentation. Does this work? Does that work? When you sell something, is it mentally freeing to come back and look at it a second time later? Or do you find yourself you really want to look elsewhere because you've made a conclusion on that stock? It's the mental frameworks that you can't necessarily replace by doing it by written word. You have to do it by experience. And that experience loads up over time such that when you become a portfolio manager or you've been an analyst for a number of years, you have a playbook. You've seen it before. You have an approach that you think works for you. It doesn't necessarily work for everyone, and experience is the only way you're going to get there.
And so you've obviously evolved your process over a long time. So what today is your investment edge? What makes you different than other investors?
Yeah, and I think there's not one thing. To me, there's two or three things that I try to bring together when I build a portfolio. I'd say one, I rely a lot on those research portfolios. I think they're an incredibly powerful tool. When you think about all the analysts at Capital going out and meeting 22,000 companies a year, coming back, having those conversations, and then they're investing in the research portfolios and what they view are the highest conviction ideas that they can find. So super rich pool.
Right. Best ideas portfolio. You're finding the best of the best.
Right. And they're incentivized to find those ideas. Second, I was a research director for a number of years where I helped hire and mentor a lot of the analysts. It really helps to understand how does each analyst use their superpower. Some of them are really good at finding growth stocks. Some of them find turnarounds. Having a better understanding of what they do incredibly well, also an important part. And then the last piece is really around where do I find the most attractive pieces of the market? So I try very hard to think out longer term and say, where are the areas of the market in terms of exposure that I think have the most long-term opportunity? Combine that with this very rich pool of investment ideas from the analysts, and knowing a better idea of what some of the analysts do exceptionally well, I try to combine all three when I think about portfolio construction.
And in that, you talk about management teams.
Yeah.
And I love asking this question. I ask it of a lot of our different podcast guests. How important is management? And would you own a company that you really love their business model, but you didn't love their management team?
Yeah.
How do you think of both?
I mean, I will be very consensus here. I think management teams are very important. Critical. And I would rather hold an A team in a B business than the other way around, anytime. And one of the reasons is the management team has the vision for what that company could be. And if they can map that out, they can take a B business and make it an A business. And sometimes the best stocks are the ones that start out at B or C, but have good management teams and end up at A. And a lot of what I look for is what they've done over time. I think you meet a lot of compelling management teams and they sound phenomenal. They're very eloquent. They understand their business. What I look to do is, did they do what they said they did? And can they actually accomplish that going forward? So I try to actually think about what in the fact pattern, the history of the company actually demonstrates that management was able to do what they said they could do.
Yeah, what they actually executed versus what they said they would do. I mean, I think that's super important. A while back, and a lot of our folks are asked by companies, by CEOs to go in and say, speak to my board or speak to a group of leaders. And they ask us to do that. I want you to share why you think they ask us to do it, how you prepare for it. You were asked to speak at a Caterpillar Leadership Summit maybe 10, 15 years ago, and you spoke to 500 folks.
Yeah.
What do they want to hear from you in those settings?
I think there's two things. One is they're looking to have investors come who know the company well and who they know the investor well. So a lot of that is, how much time have you spent with a management team? Have you demonstrated that you know their business as well as you should? And do you have insights that they think will be additive to their employee base and their leadership when you present to them? Caterpillar is a great example. So that was an opportunity in 2014 where the CEO, Doug Oberhelman at the time, asked me, we have an interest in understanding how the market perceives our stock. Caterpillar had underperformed for about 2 years. And they said, will you help us walk through how's the market perceive Caterpillar? So it was an annual leadership conference in Nashville, Tennessee, which was super interesting to go to. And I did two things. I said, first, let's talk about the market perception. How do you think about construction markets, non-resi and resi? How do we think about mining and resource, power generation, the three big businesses? And the conversation that we had with them was really around, these are out of your control. No one can know what these markets are going to do. How the market perceives them, very much out of your control. But what was in Caterpillar's control was something that I focused on, which was returns on invested capital. And I had a whole segment of the talk where I said to them, there are things that are very much in your control. You can change the levers. And as you think about returns on invested capital, which is after-tax operating profits over the invested capital in the business, that is something that the market will reward. And we had a conversation where I showed them a chart. If you look at the quartiles of industrial stocks, the top quartile of returns on invested capital did 3 to 5x the other three quartiles.
So the correlation's super high.
Super high. So the message for them, and one of the things that I tried to deliver was, there's a lot out of your control. You can't control how the market perceives mining markets, but there's a lot in your control. When you think about the returns on invested capital, you improve the efficiencies of your business and the market will reward you. The returns for your shareholders will go higher. That's something you should be concentrated on rather than how you're perceived.
So in your investment approach, you go to these meetings, these leadership summits, you may go to board meetings, you get to know companies. You talked about portfolio construction and your investment edge.
Yeah.
Talk a little bit about your time frame.
Yeah.
So I think folks know we have a long-term orientation. The primary driver of any of our investment professionals' quantitative bonuses are 8-year number.
Yeah.
Some focus on 8, some focus on 5, 3. What's your sweet spot and why?
Yeah, and it's something that I wouldn't say there's an exact answer, but it's more of understanding where the extremes don't work and finding the happy medium. So I think the majority of the market is really focused on 1 year, maybe 2, but probably 1 year.
And you're saying our competitors?
Our competitors out there in the marketplace.
Just general asset management.
They're looking at 1 year.
Got it.
Look out 10 years, I think there's an enormous ambiguity. It's really hard to make assumptions on a 10-year time frame. World could change a lot in 10 years. 5 years feels like a really nice balance for me. It's where I concentrate for my research and my portfolio construction. I feel like it's far enough out from where the market looks and all of our competitors that we can have a very differentiated view on each of those stocks. But it's close enough in that I think that our fundamental analysts that are doing all that work to understand companies, their views on the world can very much be manifested, and we can have a good high conviction on what it may look like over a 5-year time frame. So I think it balances far enough out that we can differentiate it, but close enough in that it really takes advantage of what we do well in research.
And that allows you enough time to be contrarian, because I think you like to be contrarian.
Yeah.
When one of our folks, it might have been Chris Bookbinder, said, when everyone else sees red, I see green.
Yeah.
Which I love that.
Great quote.
Which I love that comment. So, but are you a contrarian by nature in your investment approach and style, or are you not?
Well, I guess I wouldn't necessarily call myself a contrarian by nature. What I would say, though, is I had a lot of opportunities as an industrial investor to lean into weak markets. And I think that's hugely opportunistic. If you look, the market gives you opportunities. You know, when I look back as an industrial investor, 2009, global financial crisis, 15, 16, we had a big industrial recession in the US. 2020, we know well, is COVID. And then for a brief moment in time, Liberation Day in 2025. Market takes big pullbacks. You get an opportunity to lean into these stocks that are super interesting. I think there are two keys to that. One of them, you have to have the mindset. You have to be interested in leaning into a market that's selling and not necessarily thinking about what's in your portfolio today that's not doing well, but thinking about all the opportunities that are being created. So mindset's the first one. The second one is really have to have a discipline around valuation. Why those stock prices are so compelling. What I love about those pullbacks is you don't have to dream a blue case or blue sky scenario. You can actually talk about what is the bear thesis that's already priced into those stocks. So the valuation might price in a lot of the downside, so you don't have to be that inventive on the upside.
Yeah, so it might not be that quote unquote contrarian. It is that 5-year time frame allows when there's sort of indiscriminate selling and the beta of the market causes a 20 or 30% drawdown.
Yeah.
It just gives you an opportunity to find your favorites and invest in because you have that 5-year time frame.
Exactly. You can see it through to fruition.
You can see it through. Good. Let's get into a little bit on Capital Group.
Yeah.
Talk about mentors. Did you have one or two mentors that made a big impact in your career as you transitioned to Capital Group from a different type of company or as you grew through those research director roles or as you became a diversified portfolio manager from an analyst? Talk about a mentor that might have had some impact on you.
Yeah, and I'm a big believer that mentorship happens in moments. I mean, there are needs, and in those times when that mentor is available, it makes all the difference. I had a problem stock in 2011, a company called Sonova that had a hearing aid issue, and I had just recommended the stock. And exactly a month and 7 days later, they announced a profit warning, a insider trading issue, and they announced a Swiss investigation into the company.
So bad things come in threes, and you hit them all.
I hit them all in one fell swoop. Stock went down by 50%.
Right.
And I was, here for 5 or 6 years. It was difficult, and I was in a difficult headspace. And a portfolio manager named Gerald Dumanoir, he's based in London. I remember him coming to me and he said,
previous guest.
Oh, he was on that's right. He was on the podcast. He said to me, what's done is done. You have an opportunity here to do what's right for the clients and the shareholders. And that is going back and doing the work you need to do to find out what does the stock price now discount? What could it be in the future? And he said, take your time. There is no rush, but ensure that you're thinking forward and you get it right from here. And it was that moment that it really helped me realize that the capital advantage of duration and the patience that we have with each other to get to the right answer, even when it may have been wrong in the past, you need to get it right in the future. So getting that fresh mindset was super important. Gerald was the one who kind of came to me and helped me find those legs.
So it takes the emotion out of it and you're re-underwriting the idea from scratch.
As if you hadn't held it.
As if you hadn't held it.
Yeah, that's the key. And I think it's someone coming to you saying, that's the way I view it, and that's the way I would view your work. So let's make sure your work actually manifests that way.
All right, let's get into your office in San Francisco, Greg. So you talked about Caterpillar. You're cheating on them because I'm picking out something from John Deere.
Yes.
I am not very knowledgeable on what I am holding other than it's green and obviously some form of a machine.
It is.
I'm going to pass you this John Deere something, and you're going to tell us what it is and why it's in your office.
Sure. This is a John Deere combine harvester.
Oh, of course.
Yeah. You should recognize that in the future. It is a toy that I got on a visit to John Deere in 2018. I got a really interesting invitation to go to Des Moines, Iowa, where they have a test farm. And so when I visited, it was two things that really stood out as an amazing visit. One, first time I got to drive a 600 horsepower articulated tractor. Very cool experience for an industrial investor. We don't get a lot of hands-on cool experiences. Right. That was one of them. The second was, from an investment perspective, I got to see how the farms actually worked. And so there were two pieces of Deere's competitive advantage that I got to see in motion. One was the autonomy. So they had a lot of auto steer and autocorrect that machines could run themselves. And the second was the automation. They could bring this incredible technology to bear on machinery that would make it far more productive. And one of the cool technologies that I saw is called See and Spray. And See and Spray.
See and Spray, okay.
So when you think about a field, you're spraying for weeds, you typically will spray the entire field to ensure you get no weeds in the field. Deere had this brand new technology called See and Spray, where they would put cameras on the actual machinery.
Autonomous.
And they could actually see in less than 100 milliseconds the difference between a pigweed and a crop. And they would just spray the pigweed. So think about the benefits. Huge for the consumer. You and I aren't eating more chemicals. It's great for the farmer. It was nearly a 90% reduction in the chemicals that they're applying on the field. And then for Deere, this is a high margin revenue stream that takes a portion of the savings from the farmer and adds it to the machinery that they get. So it's those kind of visits that make all the difference. And this is the one that I remember well.
I'm glad you shared that. I'm going to get to the moment of gratitude. I'll trade you. You give me that green toy,
Okay.
and I'll give you a Capital Ideas Obsessively Grateful mug. So,
thank you.
Curious, Greg, what you are grateful for. We love doing this part of the podcast, and I will take a second in our 50th episode to say we've always done this. In every episode, we ask guests what they're grateful for. It's just a reminder that we all need to have more gratitude.
Yeah.
And that's a societal comment, not a Capital Group comment, but just more gratitude. So that's the context. But what are you grateful for?
Yeah, this is an opportunity to actually say thank you to someone from a long time ago. I had a teacher that was instrumental for me and really provided inspiration at an early age, and I am enormously grateful to him. You know, his name was Mr. Morris at the time. He became Dr. Morris, but he was my math teacher in middle school and upper school. So everything from pre-algebra all the way through calculus. And he had a classroom where you would come in and it was fun and loud and engaging from the moment you walked in. And he also expected you to do better. He expected you to push yourself. And it really resonated with me at an early age, so much so that I joined the math team, of which he was the teaching sponsor. And we would travel all over the state of Florida on math competitions. Not great for your social life, but great otherwise. But he made those super fun. You know, we do these weekends of bonding and getting to know each other with all the other students. And I look back and think, you know, this was someone who really drove a love of learning for me, drove a love of math. He wrote all my college recommendations. And so sometimes you get a chance to say thank you to someone who made a big difference in your life at a very early age. And my guess is he did that with a lot of students, right? There were so many kids that went through. So it's my chance to say thank you. And all the opportunities he gave me, I'm highly appreciative of.
I love finishing that way. I'm sure Dr. Morris will hear that and appreciate that. I'm grateful for you, for the other 49 guests that we have had on this podcast over the last couple of years, our amazing production team who helps make this all happen. This podcast exists because of our great investment professionals, our production team, but most importantly, it exists for our clients. And I hope they appreciate it as well. It's a good opportunity for all of us to celebrate.
Yeah.
There we go.